Good morning, everyone. This is your daily brief for October 23rd, 2023. Currently, we are looking at the gold daily futures chart. Prices opened and traded a little bit lower at the beginning, but we're back around the 1990 level, currently trading at 1991. More or less, I would like to see prices uh, consolidate here maybe a little bit, but inch higher over the next week or two. I would only get concerned if we saw, say, prices close back below the trend line. That would probably be around the 1940 level. If we saw a couple closes back below the trend line, that would make me think something else is going on, and we're not going to break out right away. In a perfect scenario, prices would just kind of drift higher, possibly into the November 1st Fed meeting or somewhere to the end of October. And then I'd like to see a swift and decisive breakout above this level in November, ideally. I'm not sure if that'll happen, but that's my most bullish base case. Jumping over to silver. Same thing, silver's trading at $23.41. Prices drifted a little bit lower just after futures open, and now they're back to kind of where they were at Friday's close. More or less, the line in the sand for me here is around $22. As long as we stay above $22, I think we're going to probably continue to work our way up. Now, if gold does break above 2090 in November, as I hope, then silver should be able to break above this 3-year trend line and get above $26. Next, we're going to jump over to the 10-year Treasury. We're backing off a little bit now, but about an hour ago, we hit a high of 5.02%. So that's a new high, and I think this is going to continue until I see a reversal candle. Right now, it looks like the trend is higher, and this is going to continue to put stress on the markets. Next, I'm going to jump over to the 30-year UK government bond. This is the gilt. Over here on the left side of the screen, this is where we had the gilt crisis a little over a year ago, and they had to intervene. That's when the yield spiked really high. We are above that level now, and earlier today we hit a high of 5.2%. So that's, I imagine that's causing some stress, and it's not so much the level; it's I guess the volatility that comes with it. So if this were to continue to spike, I think that's going to cause problems. Jumping over to the S&P 500, it drifted lower as rates made new highs. It's kind of bouncing a little bit now. The line in the sand for me here is 41.90. We got pretty good support all the way back through February, March, and April around here. I think that'll hold, but if it doesn't, if it slices right through here, if we see bonds continue to spike higher, yeah, the stocks could slice below this quickly, and we could see something blow up. I'm not sure. Lastly, I'm going to touch on the MOVE index. I spoke about this last week. We had the March banking crisis. As a reminder, this is the volatility for bonds. Prices broke out of this range, and then they consolidated and what looks like a bullish flag pattern, and I think we're breaking out. Anything above 140 is considered like a financial stress or financial panic. And what we close at? 135. This is only done measured once a day after the close. So if this continued to spike above 140 and maybe even 150, then that means financial stress in the system. And that could be the thing that makes the Fed not hike or potentially say they are going to stay on pause at the November 1st meeting. And if they announce they're going to stay on pause, that could be the signal that triggers gold to break out. We'll have to see. This is all speculation right now. The markets are fluid and we're watching, but that's what I'm looking at right now. Hope everyone's well, and we'll talk later. Bye.